Hey everybody, a lot of viewers have asked me if I could do an update on Upstart, ticker symbol UPST. They're a lending company, but there's a lot more to it than that. They develop a proprietary lending model that's designed to do a better job of predicting consumer risk than the FICO model. Um, Results have been positive in terms of the actual prediction ability of the model, but the stock's performance has not been terribly impressive. It went public in 2021, or actually late 2020, and quickly spiked, reached about $400 a share from an initial price of about 30, and kind of went full circle and fell off a cliff pretty shortly after. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. So let me share my screen real quick. All right, so this is the chart of Upstart stock since it went public. You can see right here where it went public, right around where it's trading right now. It was very, very high momentum, and for good reason. The company was growing very fast. It was profitable, which in late 2021 for a company that just went public that's growing at a rapid pace, profitability was not usually very common. So things quickly started to cool off toward the end of 2021 and definitely into the bear market of 2022. And when rates started to rise, Upstart's business started to fall pretty significantly. So we're going to talk about what changed and what to look forward to and what could happen with interest rates falling. So Upstart has performed quite well this year. If I just kind of change this to the past few months, in anticipation of interest rates falling, you can see Upstart has done really well. It's up 74% over the past 3 months alone, and that's really in anticipation of a falling rate environment. Remember, about 3 months ago is when we really started to see that the Fed was getting the go ahead to lower rates. So why has the stock done so well? So first, let's compare kind of what's happened. So here's the state of Upstart a few years ago. This is the first quarter of 2022. This was like the tail end of the boom times for this company. So you can see here in the first quarter of 2022, it generated $310 million of revenue. It had positive net income. It had about a 10% net margin, a little bit more than that. It was growing very fast. You see revenue was up 156% year over year. Net income more than tripled. Not surprising the stock was doing well at that point. During that quarter, Upstart issued $4.5 billion worth of loans to a little over 465 million customers. And again, those were underwritten on behalf of partner banks. Upstart doesn't directly loan money generally. At the time, it offered personal loans up to $50,000. It offered auto refinance loans up to $60,000. And it was really kind of hyping its market opportunity, and that's what people really were excited about. You can see they were promoting a $6 trillion addressable market, including $4.5 trillion of mortgage volume. Remember, at that time, mortgage volume was very, very high. Pretty much everyone I know was refinancing their mortgage. People were buying houses. Mortgage rates were about 3%. Small business loans, they said, was about a $644 billion opportunity. Auto lending, and of course their core personal loan market, which is even today is where they make most of their money. So that's where things stood, at the beginning of 2022. Fast forward to today, and it looks a little bit different. So here's how things compare. Up in the second quarter of 2024, this is the most recent quarter, Upstart generated about $127.6 million of revenue. That's actually down year over year, so the triple-digit growth is clearly over. And that is compared to $310 million in that quarter in 2022 that we just looked at. Both operating income and net income are very negative. You can see net income of negative $54.5 million. So that's a negative net margin in the 40% range. So that's not very, it's a big difference from where they were a couple years ago. Now, the products they offer are pretty much the same. They still offer personal loans up to $50,000. They still offer some auto refinancing. And the most recent product they've rolled out are home equity lines of credit, which you can see right there. They're just really ramping up. It is live in 30 states plus DC right now. That's up from 19 in the first quarter. So that product is just getting ramped up. They have not expanded into general mortgages. They have not really expanded into small business lending yet. And the auto lending, that was supposed to be their next big thing. That really has stalled out. So if I'm going to skip ahead to a slide toward the end for just a second, this is lending by product. So out of roughly $1.1 billion of loan volume, which if you remember, the loan volume was $4.5 billion in that quarter in 2022. So less than 1/4 of the loan volume today than they had at the height. So, but the big point here is 99% of that today is unsecured personal loans still. Auto lending was $18 million, which out of $1.1 billion is not a ton. Home equity lines of credit, which again is just ramping up, was only $8 million in this most recent quarter. Virtually all of its loans are auto loans. So the good news is that the data shows that the model works. I don't really want to get too into the data right now, but Upstart's model is definitely more effective at predicting defaults than standard methods. They take a lot more into consideration. The company just did a major refinancing. They issued $375 million in convertible senior notes due 2029. They convert at a price of $45.66. They only bear 2% interest, so it's a really low funding cost. It has the potential to dilute shareholders eventually. That would be a good thing, though. I mean, the stock price went up, and it would be less than 10% dilution if it was fully converted. So nothing to be alarmed about, and it kind of it pushes their debt maturity to 2029, which is definitely very good. The bottom line, let me stop my share here. The bottom line is that in order to be profitable, Upstart needs to have higher loan volume, period. That's how they become profitable. If loan volume quadrupled to 2022 levels, this would be a profitable business, no doubt in my mind. But it's not there. And I mean, they have more bank partners now. There's a lot more. In some ways, the business is better now. They have over 100 bank and credit union partners. They only had 55 back in 2022 when that quarter took place. But as rates come down, more people will find personal loans attractive. More people will want to refinance their auto loans, which their auto loans are all refinances. It's not purchase loans for the most part. So they offer auto refinancing. That'll become more appealing. Home equity lines of credit will become more appealing as rates fall. So there's a lot more that they can ramp up. I still like this business. I'm still a shareholder. It's a pretty small position for me. I do believe in the model. I believe there's a lot of room to go, but I'd like them to show a path to profitability no matter what the market is doing, not just when things are going well. Obviously, they've already proven this business makes money when things are going well. But things are not going so well right now, and they have the cash to make it through the tough times. Right now, they have about $560 million of cash. I showed you their net loss was about $54 million, so they have some runway. But bottom line, they need higher loan volume, which generally means they need lower interest rates. So as the Fed continues to lower rates, I would expect this to turn around somewhat, but it's not going to happen quickly. This is a gradual rate cutting cycle. I'd love to hear what you think about Upstart. Please leave me any comments you have. I'll do my best to respond to any of them individually. And thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.